Okay, it's 2 o'clock, so we can start. Good afternoon, everyone. Welcome to this ACER webinar on the expected benefit of co-optimization in the electricity market. I'm Marco Pavesi, a policy officer in the electricity department ACER, and I will kick off this online webinar with some housekeeping rules. Let's start first with the agenda, though. So we have first some introductory remarks from my side, followed by a 20-minute presentation from our consultant, Anthony Papavasiliou, which will guide through the main findings of this study. Then we will have a first Q&A session, which will last for about 20 minutes, followed by a panel discussion, which will deal with opportunities and challenging of co-optimizing the ahead energy and balancing capacity market. Following that, we will have a second Q&A question, and then Matteo Franzer will close this webinar today. As I mentioned, some basic housekeeping rules. So we will use Slido for this Q&A session. So please get to the link that you see on this slide, or you can also scan the QR code in one of the next slides. This webinar is being recorded, so you will find this on our YouTube page from tomorrow on. And please make sure to keep your mic mute throughout the whole webinar. You're welcome to pose your questions at any time during this event, but please keep in mind it will be tackled during the two Q&A session that I just mentioned. Starting with some context here. So this webinar deals with the topic of co-optimization, which is laid down under Article 40.1 of the balancing guideline. And since co-optimization needs to be part of the SDAC algorithm for the single decoupling algorithm, this is also governed by Article 37 of the CACM guideline, which foresees TSOs to submit the set of requirements for co-optimization to the NEMOS, and then the NEMOS should consider this and amend the algorithm and methodology accordingly. So this webinar is still held in this context, where we are still in the ACER process for amending the algorithm and methodology. But before that, we've already consulted you earlier this year on this topic of the algorithm and methodology, first via a public consultation, which ran from 18th of January to mid-February, and then we also had ACER workshop in the middle on the 1st of February, when we dealt with the main topics that we were asking you to answer in this public consultation. So why are we here today now? So why did we commit this study on the expected welfare gains? There are two main arguments here. First, is to support the R&D activities which have been carried out by NEMOS and TSOs in this co-optimization topic, by answering some of these open questions and giving inputs for future research areas. The second main reason is also to raise awareness on this topic, because co-optimization is one of the next milestones in the European electricity market domain. So we find that it's really crucial to build and to share knowledge on this important topic, given that it's quite a complex one. So this is the underlying context under which we're having today's webinar. And after this short introduction, then I will pass the floor to Anthony Papavasiliou, which will guide through the main findings on this consultancy study. Anthony, please, the floor is yours.
Thank you, Marco, for the introduction, and thanks everyone for taking the time to attend the session today. Can you hear me well? All right, great. So I'm very happy and proud to present the analysis that we did on the welfare benefits of co-optimizing energy and balancing capacity. My name is Anthony Papavasiliou. I'm an assistant professor at the National Technical University of Athens in Greece in the Department of Electrical and Computer Engineering. And this work has been conducted in collaboration with Daniela Villa, who is a postdoc at the Center for Operations Research and Econometrics at the Université Catholique de Louvain in Belgium, where I was formerly an associate professor. I'm going to start by providing a bit of context into the study and what precisely it is we are aiming to quantify. Can I get another confirmation that you can see my mouse hovering over the screen?
No, Anthony, I think that you're not yet in control of the presentation, so maybe you should take over at the top.
Okay, got it.
And after that, I think you will be able, yeah.
Yes.
Now
so we are now in the balancing capacity and balancing capacity market slide, right? Hopefully.
Now, yes, we're on slide 11.
All right, and you can see my mouse hovering over the screen?
Yes, we can see that.
Perfect. Thanks, Marco. So the focus of the study was on the interaction of energy and balancing capacity. First, a couple of high-level words on what balancing capacity is and how we conduct balancing capacity markets in Europe. So balancing capacity is essentially headroom for ensuring the secure operation of electric power systems. It comes in the flavor of 4 standardized products in the European continent, which are principally differentiated with respect to full activation time. Typical reaction of these products is indicated in this figure here. So we have frequency containment reserve, automatic frequency restoration reserve, which is dubbed AFRR, manual frequency restoration reserve, or MFRR, and replacement reserve. And the focus of our study is on the categories of AFRR and MFRR. The way in which balancing capacity markets are conducted in Europe, as I'm sure all of you know, is that typically transmission system operators conduct in the day ahead a balancing capacity auction where they lock in balancing capacity, and then the day-ahead energy auction takes place where which is operated by the power exchanges and where energy trades are matched. And what is interesting about this sequential setup is that it is split up into these 2 parts, although the balancing capacity and energy delivery are interdependent. That's because a finite amount of generation capacity has a mutual exclusiveness property where if you use that use that capacity for providing energy, you cannot use it for balancing capacity, and vice versa. And also balancing capacity products between themselves interact. All of this is visualized in this figure in the lower right, where you can see energy set points in the black bars. And depending where you're sitting, that affects how much upward or downward balancing capacity of different types you can offer. Now, one way to deal with this interdependency is by setting up a co-optimization design where you essentially link bids between the balancing capacity and energy markets. And you conduct a multi-product auction, which aims at maximizing the welfare generated by the allocation of these multiple products. But endogenously within the auction, you account for the mutual exclusiveness of energy and balancing capacity. In simple enough settings, this is something that will lead to an outcome that could also be replicated by sequential design. So in this simple example that we see in this figure, we have 2 generators. One is cheap with a marginal cost of 0. The other is more expensive with a marginal cost of 10 euro per megawatt hour. One has a capacity of 210. The other has a capacity of 100. And we're living in a market where you have a demand for energy, which is 100 megawatt hours, and demand for balancing capacity, which is 100 megawatts per the hour. The quote-unquote algorithm that solves this co-optimization allocation is that you allocate the most expensive units to cover balancing capacity needs first. That's indicated graphically in this slide through this shaded figure, where G2 is, because it's more expensive, it's completely allocated to balance capacity. And with the remaining merit order, which in this simple example is just the red unit, you clear the energy, and that's the outcome of the co-optimization. And that's, you can mathematically establish something that could also be replicated through a sequential setup. The reality, however, deviates from these simple enough settings. We have multiple periods, we have ramp constraints, and there are even some more difficult complexities like fixed costs that cannot be nicely split between these two markets. And therefore, we might end up in a situation where sequential setups deviate from this idealized one-shot coordination. And in such the point of our study is to quantify when that happens, how the choice of the design affects decisions that we make in the day ahead that are irrevocable, so set points of inflexible units or commitment of units that cannot be turned on or off flexibly in real time, and what that implies for system cost and market welfare. So that's the general motivation. I'm going to now give you some more specific information pertaining to the methodology. We have chosen this study for reasons that will also become clear later in the presentation today to split it into two parts. We kind of a two-stage simulation of the EU market. The first stage is what happens in the day ahead, whether that's energy or balance capacity or both. And then the second stage is what happens in the real time frame, so balancing. You could ask, why would we want to do that? And the answer is because we want to quantify exactly the benefit or the implication of coordination inefficiencies on physical commitments that you can no longer change in when you move to real time. So the three designs that we analyze are indicated in the color shading in this slide. So in the top two are the sequential designs. The blue is the status quo. The red is the market-based approach, which essentially corresponds to Article 41 of the Electricity Balancing Guideline. And the green is a co-optimization approach. In the sequential designs, what you do is you conduct the balancing capacity first, at least in the geographies that we've analyzed in our study. And that locks in the allocation of balancing capacity to specific units. And that is taken then into account when the day-ahead energy market is cleared. Between the blue and the red is essentially that in the red design, in market-based, you also allow the trading of balancing capacity between bidding zones. And then with the commitment that's determined by the day-ahead markets, you then move to the real-time balancing stage where uncertainties revealed, for instance, in the realization of wind or solar forecast errors. You've made some commitments in terms of set points or turning units on or off, and then you operate the system given this situation has occurred. Now, for the sequential designs, that one thing that is worth noting is that in order to bid in the first stage in the balancing capacity market, you have to quantify your anticipation of the opportunity cost of locking in balancing capacity. And to do that, you essentially need to make an attempt at forecasting energy prices, because your opportunity cost of locking in balancing capacity is the profit you would have made in the balancing capacity markets. And that, price forecast errors in this calculation could be one source of inefficiencies. So part of the exercise here is to model price forecasts and energy price forecasts and energy price forecast errors. This slide explains how we've done it. So the idea is to overlay a base error and on top of that, an agent-specific error. For the base error, we use historical data. For our base scenario, that's 2020 year. And what we do is for days of the same day type and time step t, we take the price forecast error as the difference between energy price in day d for that slot t and energy price for day d minus 1 of the same day type for the same slot t. That's the base error for the whole market. And to that, we add agent-specific errors that have a zero mean and a standard deviation, which is 3% of the day-ahead energy price. The figures in the right show you give you a visual feel of what this looks like for the Belgian bidding zone. So you see the 8 different day types in our study. We distinguish between seasons and weekdays versus weekends. The solid lines give you the average price forecast error, and the colored bands give you the 25 and the 75 percentile of these price forecast errors. But also, in order to test for the effect of the magnitude of price forecast errors in our study, we also consider the energy crisis years in a sensitivity analysis, which, as you can imagine, can enhance price forecast errors. Now, this, like any model, does not capture all the facets of reality. So this slide we use a unit-based unit commitment model bidding, which is a norm in a large part of Europe and for sure in the parts that we study. This, in a way, is on the one hand a methodological necessity. There is no data available for how agents would have behaved in a co-optimization setting in Europe because we don't have such a setting in the geographies that we study. But at the same time, the way we approach the study doesn't mean we do not account for coordination benefits of portfolios. I'm going to comment on that more later. Also, the assumption we make, in a way, offers a favorable bias to the designs that are sequential because the bidding language of a unit commitment model is much richer in representing unit-specific constraints and costs than the aggregate bidding products that we have in the EU. We also ignore the pricing rule of no paradoxically accepted bids. We assume a joint clearing of AFR and MFR. This too offers a favorable bias for designs that split the auctioning of these products because, again, there are interdependencies in these products, and we assume perfect competition and truthful bidding. So that's a high-level view of the methodology. I'm going to now move to discussing the results of the analysis. The analysis, as you can indicate from the icon here, is focused on the core region of Europe. So the figures that you see in the left show the relative gains of co-optimization and market-based relative to the status quo. And then in the right, they present the absolute values in euro per year for the core region. So in relative terms, co-optimization is able to deliver an improvement in terms of welfare of 2.1% relative to the status quo. The market-based design captures 0.3% of this wedge. If you translate that to absolute annual numbers, co-optimization delivers a benefit of 678 million euro per year for the core region, and market-based attains a benefit of 84 million euro per year. And if one were to extrapolate these values to the EU region based on the relative production or consumption of the EU in comparison to core, that would translate to benefits for co-optimization relative to status quo of 1.3 billion euro approximately per year, and benefits of market-based in the order of 160 million euro per year. Now, one of the most interesting aspects of this analysis is to gain an understanding of how these benefits, these coordination efficiencies emerge, and this slide is an attempt to explain that exactly. In the the short answer to this question is that there's an complex interaction between fixed costs, technical minima of units, and the possibility to absorb low marginal cost non-dispatchable technology. So to make this more specific, in the left of this slide, in the far left figure, you see the ordering of the units in our model in fixed cost. So the further you go to the right here, the higher the fixed cost of the units in this graph. The height of the blue line is the marginal cost of these technologies. And whatever is crossed here are units that are booked for reserve by the co-optimization design. And a subset of these crosses are green. And those are units that are booked for reserve only for the co-optimization design, but not the other designs. And not the status quo design. So, and you have the corresponding figure in the right for the status quo in comparison to its alternative designs. The thing to notice about this figure is that there's a bunch of crosses in the left part to the right of the figure. This means the way to interpret this is that co-optimization, quote unquote, dares to commit units with high fixed cost. The intuition of why that is happening is that since the multi-product auction is simultaneously optimizing for the allocation of energy and balancing capacity, it is able to recognize that there's a single production factor, which is fixed cost, for the delivery of two different products, which are energy and balancing capacity. And when the dust settles in the day-ahead market, that results in a aggregate technical minimum for this design, which is substantially lower than that of the status quo. So here in this graph in the upper right, you can see a reduction of aggregate Pmin in the order of 2 gigawatts. And this additional space in the day-ahead time frame allows for an absorption, a deeper absorption of technologies that have low marginal cost, but are to some extent non-dispatchable. And this is the one source of the possible coordination efficiencies, the coordination benefits that you get for accounting for energy and balancing capacity simultaneously. Now, one could also conduct this exercise on a day-ahead alone basis and ignore the fact that we will then move to real time. This is the results of that exercise are presented in this slide here. So just freezing everything in the day ahead actually exaggerates the nature of the results. So the gains of co-optimization relative to the status quo in this case, they climb up to 3.9%, and market-based design is able to reap 0.8% out of these 3.9% potential benefits. And if you absolute numbers, attains a benefit for the core region of 1.2 million euro per year, whereas market-based 240 million euro per year approximately. And then if you extrapolate that to EU level, the co-optimization gains climb up to approximately 2.3 billion euro per year, whereas market-based is at 450 million euro per year. So what happens in this intraday time stage? Essentially, we make a quite optimistic assumption in our analysis that somehow either the intraday market or the bilateral trading of balancing capacity positions or the internal coordination within portfolios is able to restore set points to efficient levels as we move from day ahead to real time. Whether you believe in such an optimistic assumption or not is another discussion, because among other things, it implies geographically broad portfolios, which kind of go against the nature of competition. But that's what we assume in order to make the analysis as objective as possible. This is one of the sensitivities that we've conducted. Now, the study goes on to conduct a series of other sensitivities, and they are summarized in this slide here. So in the left part, what you see in the y-axis of this figure are savings in million euro per year for the core region. The left chunk of bars corresponds to the market-based design. The right chunk of bars corresponds to the co-optimization designs, and we're always studying welfare gains relative to the status quo. You see essentially results for the set of sensitivities that are presented in the right part of this slide. So the base case and the no intraday corrections I've already discussed. There's one sensitivity on high price estimate price forecasters. We use also the energy crisis years, 2021 and 2022. We have in Appendix G1 of the report an assumption on what would happen if you explicitly bid opportunity costs for balancing capacity in co-optimization. In Appendix G2 of the report, we attempt to lift the 10% limit on the allocation of cross-zonal capacity for balancing capacity. In Appendix G3 of the report, we remove the possibility of trading up to 80 megawatts of balancing capacity on the Austrian-German border in the status quo design. In Appendix G4 of the report, we reduce the availability of French nuclear to the historical levels of 2023. There's an additional sensitivity on the flexibility of French nuclear, where we assume that 50% of the French nuclear capacity is dispatchable. And there's an additional range of sensitivities, but we only report the best one on the discounting of fixed costs in balancing capacity bids, where we assume that agents anticipate that part of their fixed costs can be defrayed by energy profit margins and adapt their behavior in the balancing capacity model. The thing to note here is that in the end, the ranges of the co-optimization relative to status quo range anything between 400 million euro per year to 1.2 billion euro per year for the core region. So to conclude, we show that we quantify the benefits of co-optimization relative to the status quo at approximately 1.3 billion per year. Market-based attains 160 million euro per year in the base scenario. The savings originate from the complex interaction of fixed cost, technical minima, and the ability to absorb low-cost, non-dispatchable technologies. Intraday corrections can help a lot with the sequential designs. Price forecast errors can largely, the inefficiencies of price forecast errors can largely be corrected by intraday adjustments. The explicit bidding opportunity cost backfires in a co-optimization setup, and many alternative attempts to represent fixed cost discounts in the day-ahead balancing capacity markets do not outperform in our model the full representation of these fixed costs, which is what we report in the base scenario. Thank you for your attention. Looking forward to the rest of the workshop.
Thank you, Anthony. Yeah, maybe to mention indeed, again, welcome everyone to put their questions in the Slido. There were just some at the last moment coming up in the Slido, so I would indeed start to take them from the top. Also, please vote them up. I don't know, Anthony, if you see them, but I will read them out, and we can go through them one by one. So maybe the first question I see is indeed, how do you envision the market design and bidding processes that will enable the optimal outcomes suggested by co-optimization study, particularly considering the complexity for storage storage power plants in the mechanism?
Yes, thank you, Matthew. I think that bidding product definition is one of the big frontiers that if there's a decision to follow up on this work, it's, I would say, one of the most challenging and important next steps. We had quite extensive exchanges with informal work on, one step or multi-step and directional or bidirectional linking. This is exactly the kind of discussions that we need to continue. So one thing I can say confidently is that the full set of answers are not there now, and a lot of work is needed, but there are already innovations in bidding products like blue blocks that are making progress in such direction. And for me, this is where a lot of the energy needs to be focused in the future.
Okay, good. The second question, probably on the level of cross-border capacity being available for trade. So with the implementation of co-optimization, do you expect any impact in the allocation, I assume the allocation volumes of long-term cross-border capacity?
Indeed, and this is something that was quantified, and I believe it's also reported in the results of the study on the allocation of cross-zonal capacity between market-based and co-optimization. So, of course, the design has effect. By the way, I have Daniela Villa next to me physically here today, so we report on the effects of the design. Cross-zonal capacity, I'm not sure. I recall a systematic pattern of using up more or less in one design versus another.
I think that for optimization, we were observing that optimization was using more cross-zonal capacity allocation for energy, if I'm not mistaken.
But the details are indeed reported in the deliverable.
Okay, good. Thanks. I'm managing questions as we go, but they keep going in, so I will move along. So next question is: do you assume that market participants do not take into account their fixed costs, ramping costs, and startup costs in their bidding strategy in the study? I assume.
One thing to say is that we assume truthful bidding throughout all the designs, because there are weird things. There's gaming that could come up in certain designs, depending also on make-whole payment regimes, etc. But that's a separate discussion. That was not the focus of this work. And what I said earlier about bidding languages being very favorable is that by representing units through a unit commitment model, you exactly quantify how these constraints affect what the market operator can do with a certain resource. And these constraints are present in both in the co-optimization model, they are present full stop. So that includes ramp rate constraints, min-up downtimes, fixed costs, technical minima. And then in the sequential designs, this set of constraints shows up once in the balancing capacity market model. And then what the energy market model does is it says, okay, now this unit has been cleared, but this one not. So we repeat these constraints then when agents are engaging in the energy market, which means that also when they're engaging in the energy market, they are accounting for this as they are bidding in. And one more thing to say, in fact, is that the detailed mathematical models used, the stuff I just described, is presented in appendix section E, I believe. Yes, the detailed models are in appendix E of the report.
Okay, thanks. Yeah, maybe a good question, because maybe that might come up later as well. There's a question: what is the annual welfare of the day-ahead market? But maybe I think for your study would be better to say what is the overall cost of the electricity market being cleared in your models, or maybe give some general feeling on the volumes or on the numbers.
Yeah, it's true that we end up indeed reporting cost. So it doesn't mean that consumer benefit is not there, but if ex post we observe that there is no load shedding, or if demand is inelastic, then these two end up, you're kind of quantifying the same notion with different accounting. Now, this is a tricky number when you're putting things in perspective, so be mindful of that. For the rest of the discussion today, I could be a massively inelastic bidder and bid a valuation of plus infinity, and if the market matches me, or €1 trillion per megawatt hour, and then someone matches me with a cheap resource, and then there's a 0.99999 trillion euros of welfare generated. That's not a meaningful, necessarily, denominator in a relative analysis. So we consider an absolute number in the order of €1 billion per year, an interesting absolute number. Also in the academic literature, savings in orders of 1% per year in terms of cost are numbers that start turning some heads around. So I think that's an interesting perspective to adopt when reading through the results of this study.
And maybe Anthony, to add to that, so your general overall cost figure, so you're reporting in percentage and welfare gains, but it basically means what's the total number of cost basically for the core region or for the EU-wide?
Yeah, we're scanning through that now. I'll give Daniel a minute to scan through that. We can go to the next question, and then I'll give you that number in a moment.
Perfect. So basically, next question here is there any fundamental change expected on making the capacity of interconnections available today at market after implementing this proposal?
As opposed to keeping it out of intraday, for instance?
I assume, yeah. I think it's on the capacity calculation. I assume it's on the capacity calculation processes and the provision of horizontal capacity to the day-ahead market as it's currently done, either NTC or flow-based.
Well, in the end,
fundamental difference. Yeah.
I don't know if I wouldn't be confident on commenting on that, in the sense that the domains are what they are, and that's based on the processes that we are all aware of. We sourced our data from JAO. There are very interesting issues to keep in mind when it comes to reserve deliverability. So if I'm trading balancing capacity in a certain bidding zone, and that balancing capacity is sourced from different BSPs in other bidding zones, actually the more interesting case is if there are multiple TSOs procuring balance capacity from that single BSP, then you have to be a bit, in a sense, pessimistic when you're allocating balance capacity to make sure you don't overload the network, because each of the TSOs may activate 0 up to their procured balance capacity demand or anything in between. And that becomes a whole range of things that could materialize in real time. But, and this is, by the way, referred to the deterministic requirement. It's a requirement that we've discussed extensively with the TSOs, and we've worked on innovations to represent it and clear it algorithmically. But that's endogenously represented in our model. And as the input to this, the flow, the polytopes are given, they are what they are. And the question is how you can cope with this, uncertainty in the actual activation of TSO demand in real time.
Good, thanks. I see.
Sorry, Matthew, to interrupt you. Let me.
Sorry.
You have a number?
3.2 e to the 10th, or let's say overall.
Is that 300 million approximately?
Okay.
No. So 3 times 10 to the 10th.
Yeah, the 10th. It's the overall picture.
The overall cost, order of magnitude, figure 8 of the report.
Okay. Thank you. So another question that keeps going to the high ends is how do you explain the reduction of overall welfare gains in case that 50% of French nuclear are flexible in one of your sensitivity analysis?
Right. So that's a very interesting question, and the idea here is that the question is how many, to what extent there are irrevocable decisions when moving from day ahead to real time. And if you can undo a large part of your scheduling inefficiency of the day ahead when moving to real time, then this coordination inefficiency starts becoming less severe. Now, the reason we even, there's an interesting differentiation between nuclear technologies as we understand it from the background analysis that we've done during and also after the study. Also, depending on geographies, US versus Europe, and also within Europe, which countries actually use flexible nuclear technologies. From the background journal academic literature that we've read, it's our understanding that it's largely German and French nuclear capacity that can be more flexible, and with the given the German side kind of becomes less relevant. So then it's interesting to focus on the French aspect. And some of the interesting numbers that we've found is significant load following actions can be acceptable up to twice a day, 5 times a week, and 200 times a year. Now, representing that computationally and precisely requires an escalation of our model that we for various reasons is not possible. And as an approximation of that, we say, okay, as 200 times a year starts, resembling about half of the year, we just assume that half of the nuclear flexibility, half of the nuclear fleet is flexible, and then the savings from that result from the reason I just mentioned earlier.
Thanks. I don't know if the next question is a academic question or more from stakeholder side, but the question is, can we get access to the code and the data to replicate the study? I know you have some information in the back of the study, but I'm not sure if this is.
Some of the data here. So the data on which the study is based has been used in other journal publications as well, and to the extent that some of that data is so. For instance, there is a paper by Ignacio Aravena, Quintan Leten, myself, which actually also received the runner-up for the best energy publication from the Institute for Operations Research and Management Science, where it's the same starting data that we used, and to the extent that that data is available, you can access it from these papers. Some other data, on the other hand, is confidential due to the fact that it's sourced from industrial collaborators, and but there's still, I think, quite a lot of interesting and useful data already, even in this report, like for example the core region reserve requirements, combined, JAO, anyone can enter a lot of the data we've sourced from the ENSOI transparency platform. So it's some extra work for groups to go through that process, but a lot of this data can be assembled bottom up. But I would be uncomfortable to commit to something like that on this platform to hand out code.
Thank you, Anthony. I have another one going up in the ranks, and that's the question is: have you backtested how different SDAC results would have been from actually applying the same data set used for co-optimization?
Yeah, that's also an interesting question. So referring to these former scientific publications, one of them was Aravena and myself in 2017, I believe, published in IEEE Transactions on Power Systems. We did a calibration at that time for testing for the reliability of that database. That, by the way, was also the data set used by Leten Aravena in the OR paper, if I recall again correctly. So in Ignacio's paper back in 2016, 2017, I think it was, we compare for the CWE region, the fuel mixes of different technologies, what the model says would happen versus what actually happened in historical circumstances. There's similar exercises that have been done by our team for the Belgian market, but that's a bit too narrow to, this is much bigger than just the Belgian system. So that's the most extensive calibration that we've conducted.
Okay, thank you. I think we have a question for a few more. Yeah, so a question on self-dispatch versus central dispatch. So can this optimization model perform in similar way for self-dispatch and central dispatch systems?
Sure. I mean, we've had in the past with colleagues like, and so in past co-optimization studies have all been phrased in a context of portfolio-based systems where the market runs as and the intention back at that time was to minimally shake up the existing system, the existing products and everything. So you do a multilateral bid linking of energy products and these newly introduced balancing capacity products. It can be submitted in the form of portfolios, and then the whole nomination process as we know it, and you clear that for an integrated energy and balancing capacity market. And then the nomination process that is more typical of self-dispatch systems ensues as we know it. So the intention at the time was to be as minimally intrusive as possible. Now, okay, that's still an aggregate exercise, and arguably you could get more precise if you get more granular. But there's a whole debate of how granular you want to get in a regime where we have tons of integration of tons of distributed resources, etc. That's not the point of the exercise that we've done here. But my quick answer to the question is yes, it can work, even if not with the precise models that are presented in this paper. But there's a whole bidding product exercise that has to happen before that. That pertains to the very first question that you raised, Matthew.
Thanks.
And which for me should be, just one more thing on it, and which for me should be a top priority in the R&D moving forward, bidding product definitions.
Good. I have a final question, I think, the last 2 minutes. Which I think is interesting. So is there any study on different sequencing schemes? So for instance, rather than changing SDAC, one can run balancing capacity market after the day at energy market, then no forecast error or fixed costs need to be considered in balancing capacity bids.
Yeah, I can. Whoever is interested can reach out to me. We've in our group done some modeling of that type, so I'm happy to follow up. On the other hand, I also understand why we do it the way we do it right now. I do understand the fact that security is important, and you probably want to lock in resources if you want to split this process and do that first before opening it up to the energy market. Of course, a co-optimization setup does that intrinsically and endogenously. How you sequence things and how you account for opportunity costs becomes incredibly complex, and switching the sequence is a big shakeup to that complex, and it goes through a whole new exercise of which opportunity costs are we accounting for now. So whoever is interested, I'm happy to follow up with some of our own work on this topic, where we also reference other academic work in this area.
Good. Thanks, Anthony. We have still a lot of questions. I will probably keep some of them maybe for next, so keep voting on them. We have another Q&A session coming later, and I assume there's some time there as well. But now I give the floor to Henny for the panel session.
Thank you very much, Matthew. Hello, everyone. My name is Henny Radanovic-Knežević, and I work with Matthew and Marco in Electricity Department of ACER. The name of today's panel discussion, the title is Opportunities and Challenges of Co-optimizing Day-Ahead Energy and Balancing Capacity Markets. I will now also introduce the panelists. It's Christopher Zumas from Henex, speaking today on behalf of all NEMOs. Then Jérôme Dehaan from Tenet TSO GmbH, speaking on behalf of all TSOs. Donia Perhusseini from Euroelectric, and Reinhard Kaisinger from Magnus Energy. So I would like to invite the panelists also to turn on their cameras. Following this panel discussion, we will have another round of Q&A. So please, you can ask anyone from presenters, but if there is a specific question to a specific panelist, please also write it down there so it's easier. So yes, also before I read the questions, there'll be around 5 minutes for each panelist to provide their views. So the first statement is as follows. The study shows that the potential welfare gains of co-optimization are significant under given assumptions. Do the findings of the study constitute a solid basis for NEMOs and TSOs to continue the R&D work on the implementation of co-optimization? So that would be the first one. And then the second, when it comes to its implementation in the single day-ahead coupling algorithm, several complexities need to be thought through to exploit its full potential. And the question is, what are the main challenges of implementing co-optimization in ESDAC and how to overcome them? So with this, I give floor to Christopher Zumas to present his view.
Thank you, Henny. Thank you for introducing also to the panel. So for the two sections question, and at least for the first part, the study that we have read is actually an exercise approach for presenting under some, however, far-reaching assumptions compared to the current single day-ahead coupling, single intraday coupling, and balancing capacity markets reality, two different scenarios of balancing capacity market integration in comparison, of course, with the status quo balancing capacity markets, and illustrate the theoretical proof of optimization. However, the welfare cost gains presented may be considered negligible compared to the current stack yearly welfare figures. And so prior any implementation and investment decision by a methodology update on optimization, the NEMOs are in favor of evaluating the principal market design impacts of optimization with a realistic approach. And that brings us to the second part of the question, where the NEMOs are currently considering the following principal items for the way forward which concern the ecosystem. So the first is the proper selection of bidding structures for balancing service providers, capturing the costs, but also providing pricing and scheduling feasibility of contemporary and future asset types, which will provide the balancing services. Secondly, the pricing rules and implications for the short-term and long-term markets. So the complexity of optimization and the impacts to the market markups affecting existing and future investments to secure the energy transition should be thoroughly presented and digested by the ecosystem. Third, the incorporation of the balancing capacity markets in SDAC would require huge changes to the current industrialized SDAC in several levels, not only to the algorithmic performance, but also to the product's availability and design, to market timings, to backup and fallback solutions and procedures, changes to the standards, RFCs and CCP procedures, governance, operations, legal, contractual, regulatory, etc. So we are speaking about a profound market redesign, which is affecting everyone in the market, and the relevant costs and associated with investments should be taken into consideration by the whole ecosystem. And fourth, finally, the prioritization of the optimization project versus other ongoing common NEMOs and TSOs endeavors, and also market endeavors, should be carefully considered at the occasion now where the electricity market design is focused on storage, demand response, renewables, energy integration, and further EU market integration and extension. So such a landscape formulation reform that we are speaking now may set barriers to equally important or even more important market evolutions. So therefore, such a prioritization should achieve a proper level of acceptance by the ecosystem. So we have already performed a very summarizing evaluation, pre-evaluation of the study prior sending, of course, our official NEMOS contribution in the public consultation. And this moves us to the first slide of the presentation, Henny. So when reading the study, one could consider that this promotes a proof of concept quantification of welfare cost gains of optimization, and also with a proposed modeling framework for quantifying such benefits, and is also targeting to cost savings and more efficient scheduling of balancing resources. But before using the study as a tool on the road for a technical approach of modifying a methodology like the algorithm methodology for the purpose, we should consider the following systemic market design items which are not currently tackled by the study. The first one is the price formation. So the model and analysis neglect the price formation rule and impacts of optimization and concentrate on efficient scheduling of balancing resources. But the pricing signals are not incidental for the market, so they are the heart of the market and the heart of an efficient short-term but also long-term evaluation. So then comes the barriers to entry for market participants. So the difficulty of market participants to understand how the prices are determined could also result in a difficulty in their ability to enter the market. So this is a sub-consequence of the pricing implications. And then the bidding model for day-ahead market participants. So the electricity market design already ruled out the possibility of making unit-based bidding mandatory. But the model currently seems to follow up on this assumption. Of course, there are specific references that unit-based considerations could be, let's say, easily or could be considered on the second phase with some sensitivity analysis. It will be very helpful if we can follow up on that kind of considerations to see how these assumptions could be therefore applied to portfolio bidding. And in the next slide, we have already tried to summarize three basic areas where we see that although by construction the optimization could expect it to give some improvements, we already identify some shortcomings out of the study results. So the first one is about the relevance of the outcomes. The study claims for almost 1.3 billion euros per year gains of optimization when compared to the status quo for the EU. But these welfare gains, if someone compared them to the actual SDAC yearly welfare figures of almost 4,000 billion euros per year, are actually irrelevant or even could be overindulged finally by regular SDAC welfare variations due to SDAC requests for changes. And then we have the results that are based on analysis performed in the core region. And there is a question that the core region is therefore taking as a multiplier for the rest of the EU. We really think that this approach is much simplified or even misleading. And then the central idea of the SCOOC that we have seen modeling for optimizing the allocation of energy and balancing capacity is actually resembling a centralized approach of market operation, which is simply far away of being considered parallel to the EU real-world considerations, such as markets operating under self-balancing or self-dispatching models. Then it comes to how these achieved gains are comparable to the underlying assumptions. So it is the comparison of the gains versus them. So the study disregards the portfolio bidding, this is for sure, which is the typical EU physical delivery markets operation approach. And the unit-based bidding considerations and modeling of the scope are not easily extended to the current EU portfolio bidding. It remains to see how this could be applied. But when we come finally to the portfolio bidding, we have to consider also the intraday market. And the EU has heavily invested in the intraday market precisely to handle the supply and demand volatility problem, and further investing in new market solutions to replace or complement the benefits expected from the intraday market should be motivated now in light of the analysis of market design, pricing, and bidding behavior. And this is not provided by the study. And finally, also the modeling is focused on contemporary generation cost modeling with marginal prices, but considers less for demand response, batteries, and storage. And then, finally, and I'm closing with this, when we come to the caveats already mentioned by the study and an extension finally to the real world scenario. So moving from offered costs to offered prices, the welfare can change drastically since the markets are not operating in a perfect competition environment. And when moving from integrated bids to bids linking, the bidding strategy of market participants based on today's products, at least, could become extremely unpredictable and complex. And the main benefit, stated by ACER, is the better scheduling of balancing resources, is actually related to the unit-based bidding modeling assumptions. And if we switch to portfolio bidding or use different bidding formats like bid linking, we are no longer guaranteed to have the same scheduling efficiency, nor the same pricing signals, which is in the case are not evident by the study. So exactly all of these items that are now mentioned for caveats or for an extension to the real world scenario is actually the considerations that the NEMOs and the TSOs are having during this continuing phase of R&D in 2024. Thank you.
Thank you very much, Christopher. It's almost within 5 minutes, so thank you for this. Let's move on to the next panelist, which is Jerome. So Jerome,
Hello.
please, the floor is yours.
Thank you. You can hear me?
Yes, we can.
Yes, very good. Thanks. Then related to the questions, the two questions. So do the findings of the study constitute a solid basis? TSOs would like to really answer clearly no on this. They are not for us a proof to start an implementation of co-optimization. We try to understand the study, but for us it's in a theoretical setting that does not present the reality now or in the future, and therefore for us it's not a basis to do now something else. Even if the study results would be completely true, they wouldn't change anything for us at the moment. And we are not even the market design is completely decided, but also a lot of other aspects where co-optimization is very complex and very interdependent. All these other aspects also need a lot of attention, which should be tackled before talking really about the implementation. So the main challenges, the second question from ACER, the main challenges are beyond the technical complexity of making this possible, computation time, robust fallbacks, but it's also about correct price formations, how market works, incentivizing them, price signals, liquidity, securing the balancing needs in the future. What about governance, legal aspects, a lot of other issues that we still would like to solve together with the NEMOs. So that in a nutshell, the answer on the two questions. We also have 3 slides. Henny, you may go to the next one. So very complex interdependent system co-optimization. In the pie chart, you see we have the feeling the focus is now too much on the market design, on one specific market design. We have a lot of different market designs on co-optimization. Think back about the implementation impact assessment where we analyze different ones. They all, like a gearbox, if you change a detail there, it all has an impact on all the other pie pieces, and there are more than these, but this is at the moment the concern of TSOs. So what we would like is to have a very open-minded R&D where we explore the total picture here. And together with the NEMOs, at least behind the scenes, we are definitely working on that. But we really would like to put all focus on that before we talk about implementation of co-optimization. Yes, we acknowledge the study, respect Anthony and his team doing the work, but for us, and then we can go to the next slide, we cannot conclude anything based on that, and we fear that regulators will do so, that it will have an impact on perhaps the timelines, on deliverables, etc. So here's a list, this slide and next slide, on concerns related to the conclusions that are drawn then. So for us, the assumptions, sorry, previous slide, Henny. The first one, so the assumptions made, the data used as inputs for us to quantify and really say these are the true savings welfare. For us, that's not a reliable way to do so. The way how the market-based will work according to legislation, how prices are formed, how market participants will bid based on these new structures. We don't think that the study is a well representation of that. Also the pricing for us TSOs, the balancing pricing in particular, how that works, we think in practice it will be different. And also the impact on intraday and especially the balancing energy market is for us not clear. And yeah, we would like to see more clarifications in order to draw any conclusions. Next slide, please. So as said before, study uses some technologies that deliver something. If we look to the future, and I think in the questions before, in future we talk also about storage, demand response, renewables, who provide the services of the future. They all have a different way of defining cost and eventually a bit in prices. Markets need to be attractive to participate on. Perhaps a balancing market needs to be even more attractive than a day-ahead market. But in the study, we had the feeling it's valued equally. Is that really true? Different products. Also said, does it represent central dispatch? We have those systems. So to conclude, gray box, I have 5 seconds. For us, we say, from TSO side, we cannot draw a conclusion on the welfare to really talk about an actual implementation of co-optimization. But yes, the outcomes can be used for the further steps of a very open-minded R&D work. Thank you very much.
Thank you, Jerome, for providing your view and staying within the time. So let us move now to Donia from Euroelectric. Donna, floor is yours. We cannot hear you, so try to unmute.
I forgot.
Yes.
Yeah, sorry. Good afternoon. Thank you for having me. So before moving to the next slide, I can also share some preliminary remarks on the study. Although we concur with the responses provided by NEMO's and TSO's colleagues. So firstly, we welcome the objective of conducting the CBA for the co-optimization project. We find that the study presents instructive findings, serving as a good start for further discussions. But as mentioned by our colleagues earlier, it remains highly theoretical at this stage, and it would be beneficial to consider more practical challenges, implementation costs and resources before proceeding to implementation. I can also provide you some examples where we believe the study could be clarified and supplemented. Very generally, clarify what is included within the estimated welfare gains. We struggle to understand whether the welfare reduction due to increased price spread in the day-ahead market was included. If it's included, more details should be given. If not, then the CBA should be complemented. We also appreciate the focus on eliminating price forecast errors under co-optimization, and we take note that important part of the welfare gains is attributed to it, but in our view, the method for calculating these errors is not enough accurate, and we don't find that it represents correctly the market participants' efforts, that they put efforts into the price forecasting. So potentially it's overestimating the welfare gains. I was still on the previous slide, but it's okay. Don't worry. Yeah, and finally, and I'm coming back to my first general remark regarding the theoretical aspect of the study. It could benefit from closer alignment with practical implementation realities. For instance, the challenges related to the one-shot optimization, which you mentioned as a hardware problem, are simply addressed using linear programming approximation. Another aspect of reality that we think is a bit overlooked is that features under consideration in the co-optimization implies asset-based bidding, which is not the model applied in the vast majority of member states. EU member state, as highlighted by our NEMO colleague, and is not compatible with the EMD. And now if we transition to the next slide to respond to the second question and discuss the path forward. So we recognize in theory that there is a potential benefits with the co-optimization project, but the current focus should be on addressing technical challenges. The key question is whether overcoming these challenges is feasible, and it appears really clear that R&D efforts are needed. So to our view, the first step should be to put on hold the implementation process and do not decide on any implementation deadline until technical feasibility is proven through R&D. We strongly emphasize the need to take sufficient time for R&D, allowing TSOs and NEMOs to thoroughly assess and, if feasible, implement co-optimization. And unfortunately, the current process and ongoing consultation is not a really good example in that sense, since we have a very short period to react on this report, less than 4 weeks. So this is not this does not meet our expectation. And there is also important to emphasize that there is also high value to ensure that market participants are consulted on the R&D work to ensure that co-optimization process and bidding is adequately defined before any R&D starts. So from, as displayed in the slides, from our perspective, the fundamental requirement that must be satisfied by more R&D in order to make co-optimization acceptable include the list of these preconditions. Multilateral linking is a must to optimize FRR procurement. Market bidding complexity must be proven manageable. Obviously solve all the challenges regarding the algorithmic complexity and compatibility with flow-based, no product regression, and in addition to proving technical feasibility, clear welfare creation must be demonstrating, taking into account all above and all time frames. And we consider that in case that there is a failure to meet one of these fundamental requirements, it should lead to stop the co-optimization implementation. And lastly, let's not forget that co-optimization project and the subsequent R&D are a great fit for the ongoing project prioritization efforts. We can use this as a chance to assess the level of importance we give to each R&D task. And since all the stakeholders are involved in this process, ensure that it is adequately a framework and fit for purpose. Thank you.
Thank you very much, Tonia. Let's quickly move on to the last panelist for today, Reinhard. The floor is yours.
Hi, good afternoon, everybody. Thanks to ACER for being invited to this panel, and I have prepared also a few reflections on the questions asked and on the study. And Henny, if you would move to the next slide, and we dive right into it. So first, a few reflections on the study. a more concrete points that came to attention is the first one being that the social economic welfare gap between co-optimization and market-based appears large, with almost a factor 10 in between. The question here is, with a perfect foresight model in market-based, whether we should not come to a result that's fairly close to co-optimization, then only accounting for the inefficiencies that arise from the sequential allocation and clearing. And also maybe leads to the question whether the double counting of fixed cost in the sequential designs is a reasonable assumption, yes or no. Then co-optimization and market-based, regardless of what would be implemented, would reduce intraday cross-zone capacities, because capacity will also be allocated against the day-ahead direction in one way or the other. And this then challenges a bit the assumption that positions can be corrected in the cross-zonal intraday market due to an insufficient level of cross-zone capacities there. We see it currently also as an issue both in core and the Nordics with flow-based and then ATC extraction needed for the intraday timeframe, that we have isolation of bidding zones already. And this will probably be aggravated by also allocating capacity against the day-ahead direction. And then final point, the scaling that is done from core to EU level, which was done based on consumption production, is also a bit questionable. Why? Because if we look at core as a CCR, which is a constellation of bidding zone borders, not all production and consumption of all the core bidding zones happens through the core borders. If you take an extreme example, France, 2 of its bidding zone borders are in core, but certainly not all exchanges of cross-zonal nature take place on those. So here, it could be thought of to maybe use the allocated volume within core versus on EU level as a scaling factor, and check whether those outcomes would substantially change the results on EU level. Then on the challenges for the implementation of ESTAC, I think the complexity, especially in conjunction with other implementation efforts, have been mentioned. Flow-based with advanced recoupling in core and the Nordics, the products portfolio available, 50-minute MTUs as of lately. And I think here it's important to agree on a bigger picture and objective overall. What should ESTAC deliver? And what kind of potential trade-offs between those requirements need to be made. And then should the train move forward with co-optimization, indeed more R&D work will be needed for ESTAC, but then not just for co-optimization itself, but for co-optimization plus all the other requirements that are foreseen to be implemented. And if we move to the second slide, please. Again, more a bigger picture, and now in terms of process, the complexity of co-optimization and or market-based does not only manifest in its allocation stage, either in ESTAC or before ESTAC in case of market-based. We would see implications also in the later timeframes, and quickly avoid on those. So intraday capacity calculation and coordinated security assessment would be affected by capacity that's been allocated for the exchange of balancing capacity, because this capacity needs to be kept open all the way until real time or the balancing timeframe capacity calculation stage. So this needs to be reflected in the respective methodologies, and processes and concepts need to be found to account for this. Anthony mentioned it earlier. What is the probability that certain reserves will be called upon by a certain TSO across a certain border? This needs to be accounted for when dealing both with intraday capacity calculation, but also coordinated security assessment. And then similarly for the balancing timeframe capacity calculation itself, the previously allocated capacity for the exchange of balancing capacity would be a kind of minimum capacity for this process. And so here the processes and methodologies that are in place here today would have to be adjusted to account exactly for this aspect. And so key takeaway here should be that, yes, a lot of additional R&D work is needed for SDAC, but also for when we talk about SDAC post-coupling processes and then the intraday process all the way to real-time. There's a lot of puzzle pieces that still need to be laid out and put together correctly. With this, thank you very much, and looking forward to the Q&A.
Thank you very much, Reinhard. And also thanks to all the other panelists. So let's move on to the next and final Q&A session, and I give floor to Martin Wieghauser.
Yes, thanks, Henny. Thanks, everyone, for sharing their views in the panel. I will go through the Q&A session. I think there is still quite a lot of questions from the last Q&A sessions in there. We will, in general, address all the input to the public consultation as ACER, as we usually do. So if you have any specific question to a panelist, please clearly indicate that, so I can prioritize this. So not only now we have the chance to ask the panelists also, while generally the questions or points you put into the public consultation will be in any case answered within our decision. So for now, I will just start with the questions which are prioritized so far, and I will check if there is any specific question to a panelist. I will clearly mark it as, or clearly refer to it like that. Or actually, I have one. The second highest question is anyhow already listed to the panel, so it's question number 2, where Ensight quantified the welfare benefits of a female at an average of 2 million euro per trading session, and it seems largely different from the welfare of 4,000 billion per year which was shown on the NEMO slides. And Christophorus, if you could explain where these 4,000 billions are coming from and how they're calculated, just to be sure how we should understand this number.
So yes, according to the 2023 at least CACM annual report figures, we have an average welfare per session for SDAC 10.9 billions. Okay, so with a minimum of almost 9 and a maximum of almost 14, if you make the maths, finally for each one of the individual days, this goes around to 4,000 billions per year of SDAC welfare.
Okay, thanks. So it means basically all the buyer surplus and seller surplus of the auction. So that's the wealth, like, yeah.
The welfare.
That's not welfare gains of coupling, but the surplus of the auction. So basically compared to not having market or something, or I don't know.
It contains already all the factors, as I understand, Martin, of the market and the cross-border.
Okay, so national plus cross-border. Okay. Then I don't see for now any further targeted question to the panelists, so I would just go through from the top again. So we have one question or one remark, whether which is, does this have an impact? Does this have impact the batteries and storage assets? So how? Yeah, maybe I don't know, Marco or Anthony, if you would like to follow up on this, as what's the role of battery storage for our study, and how do we see the role?
I can,
yeah,
for sure comment, but can you repeat the precise question?
It's more of a very short remark. Does this have impact on batteries or storage asset, or maybe it's, so that's literally what it says here. I would assume the question is whether Yeah.
whether battery and storage, batteries and demand response have an impact. I guess is the
Yes,
question.
I would understand it like this. So
Okay, yeah.
yeah, how we consider.
So I can say a couple of things on that. So one thing that is common between batteries and demand response to some extent, at least, is strong intertemporal coupling. Another thing that is also common is a lower scope for short-term fixed costs. So this can go either way, I think, in the overall analysis. When you're comparing sequential designs to a co-optimized one, because the reduction of the scope of fixed cost effects could lead to smaller wedges between the designs. One of the main things that we found in our analysis in the end was that fixed cost is a big driver, and actually maybe I take also the opportunity to correct your electric intervention. We don't see a very the effect of fixed cost is much more significant than the effect of price forecast errors. So we apologize if that was not clear in the original writing of the report. Now, on the other hand, these are resources that you have to coordinate throughout the day. And we overcame this in our modeling exercise by effectively the storage resources that we represented were pumped storage hydro. And there, if you start reasoning in terms of how a sequential design bids these resources, what is considered the opportunity cost, it becomes a very severe very difficult exercise. And actually, FTI, that has conducted a study similar to ours for the Great Britain, has found it's kind of would probably be in a position to confirm this. And the ultimate, we override that in our study by just fixing the schedule of these storage resources to historical levels for the base year that we simulated. But what the FTI analysis, for example, shows is that when you have storage type resources in sequential setups, you might have herding because bids for opportunity costs are essentially driven by opportunity cost estimates. And if a lot of people expect the high energy prices to be in a given period, then a lot of people expect the high opportunity cost to be in a given period, vice versa. So there's a big herding effect that can create very significant coordination headaches for resources that have strong intertemporal linkages, like, for instance, storage, or possibly some types of deferrable demand response. So we were fortunate enough to not have to deal with these headaches in our study because we did a proof of concept for the base reference years of the recent past. But, looking forward, one could rationalize an argument in which a co-optimized approach that overrides these coordination efficiencies could deliver even more gains from that front, even if fixed costs have a lower scope. So that comes back to my original point. This could go either way. The honest answer is we never did that. We were asked to simulate the present, not 30 years into the future.
Thanks, Anthony. I would just take the next highest ranked question for now. I think it's still again a question for you, Anthony. So could you take us through the impact of explicit bidding on reserves within co-optimization and how this compares to the existing situation on the sequential markets? And then in the brackets, mainly, what are the remaining benefits under such assumption?
The bracket part, not sure to understand, but I can for sure comment a bit on explicit bidding in the sequential designs as we did it. So here we tested a whole family of alternatives. So in the very first versions of the sequential models that we set up, you essentially were bidding opportunity cost based on anticipated energy profits. That was found to actually be way too agnostic in terms of fixed costs. So then we realized that fixed cost has to be part of the exercise. What's interesting, by the way, is that if you take a marginal argument where you say, what is the intrinsic additional cost of locking in 1 extra megawatt of capacity, you find out from the analysis that it's just the opportunity cost, because in a continuous approximation of reality, you've already booked that space for offering energy, and then if you decide to allocate it instead to balancing capacity, that fixed cost is already incurred, so it doesn't enter into the incremental argument. The problem is that reality with non-convexities is not incremental, so you now have the difficult exercise of taking something that is genuinely non-decomposable, which is fixed cost, and trying to nicely split it between buckets of energy and buckets of balancing capacity. On top of that, bidding in markets is not an overall cost exercise, it's an incremental cost exercise. So if it's already hard to split it between energy and balancing capacity, it's also very hard to split the increment between energy and balancing capacity. So best workaround we could figure to that was variations of the base model, where we were accounting for the fact that agents would anticipate that part of their fixed costs would be defrayed, and endogenize that in their bidding of balancing capacity. Again, the ones that we report, we present the report, are the most optimistic versions of that exercise. Some of the variations we tried failed horribly in terms of coordinating fixed costs, and this an intuitive level in the end on not being sure a priori which of the hours you will be on. Will they be consecutive? Will it be interruptions? Will it be 10 hours or 24? So, you know, there's a lot happening there that is very hard to anticipate. So the ultimate, you know, answering to the original question that you posed, Martin, there's a whole flavor of alternatives that we tested, and the way you can think of that intuitively is products of the variety of the energy market variety that account for both fixed costs and a variable component like scalable mix, which are multilaterally coupled with balancing capacity offers without without an explicit opportunity cost. They are just multilaterally linked to these offerings, and the model then understands that this is a resource I can commit it. If I do it, it's going to cost me something. And that's in the co-optimized setting, but then in the balanced capacity setting, it's just a resource that has a variable component depending on how much reserve I'm booking, but there's also a fixed cost included in that.
Okay. Thanks, Anthony. We're almost running out of time. I just see one question which is directly addressed to you, Anthony, but as we don't have a lot of time and it's a little bit broad, I would just say if you could just have a very short answer to that. So just about how you react to the broad criticism brought forward by TSOs, NEMOs, and Euroelectric. So just before we close up.
I've been very happy to have the chance to interact with our colleagues on this, and I'm not, you know, this is not a surprise. Maybe just some factual points again. Be careful about what the denominator of what you're comparing with. If I have infinite valuation and I produce infinite welfare in a certain context, the denominator can be massive, but and a meaningful denominator is maybe annual system cost. So I very much respect the time and input that our colleagues took into going through our work. I'm not going to spend these last 3 minutes to kind of raise such detailed points here and there. So overall, it was much more positive than what I thought. So thanks to all of you for taking the time to go through our work carefully.
Okay, thanks a lot, Anthony, and also thanks again to all the panelists. Unfortunately, we will have to close this Q&A session already. We're already a couple of minutes over time, but then I would just move back, give the floor to Matthew for some closing remarks before we close the call. Thanks a lot.
Yes, thank you, Martin, Marco, all the panelists, Danny, for the workshop today. Indeed, the topic is important, and indeed is also a bit divisive, as you've I think heard today. I would maybe start with a bit of historical step back. So market coupling, short-term markets, integrated short-term markets in Europe are very important for welfare, for keeping consumer costs of electricity down, and making sure that indeed, well, we use the most efficient resources for serving the electricity that the economy needs. And also the short-term markets, those integrated short-term markets, and their efficient use of also the transmission capacity, cross-zonal capacities in it, is indeed of paramount importance, and has delivered huge welfare benefits over the last decades. I see that the discussion we're having today in this workshop, but also in other groups, on co-optimization is largely similar to the discussion we had on implicit versus explicit auctions in the early 2000s. So having explicit auctions, having separate exchanges, the inefficient dispatch between them, because the timing and the alignment of using cross-zonal capacity for the day-ahead market at that time was inefficient, led to huge inefficiencies, inefficient dispatch of units. And I think we're now at a next step in short-term market optimization. And we're in that step because markets are moving closer and closer to real time. There's more and more renewables, solar, wind, storage, all those new assets indeed coming, while at the same time the TSOs still need their resources, still need their reserves in order to balance the system, to make sure that the light keeps on and the frequency in the European power system is stable. And those processes are moving closer and closer to real time, and they're actually real processes. Things that people need to do. They need time for that. And the time is scarce, and especially time is scarce if you're doing things sequentially. So we consider that indeed improving the short-term market processes is very important for the future electricity system. It's important to keep the cost down for consumers. It's important to keep the system safe, to have the reserves available. And we do consider, and I think that this is why we did the study, we consider that co-optimization is able to deliver that benefits, but at the same time, and I hope we've shown, and I hope the study's shown, that there is cost savings to be made, to make sure the difference between cost savings here and the welfare benefits co-optimization is generally the same, but indeed it's just the denominator that is a bit different. We do consider that the 40 billion of total cost on a yearly basis is indeed the cost of supplying electricity. But indeed, if you calculate with a 4,000 price limit, then you get to different welfare benefits, which is exactly the 100-point difference between it. We firmly believe that indeed 2 to 3% welfare benefits are there, maybe indeed even higher. And we need these kind of systems, these kind of improvements in order to make the future power system work with all the renewables coming. Then, by when? So, and how? So we are currently, and indeed the study is a proof of concept study, as was said in the beginning. We want to show that there's benefits. We want to show what those benefits are and where they come from. But indeed, there is a lot of R&D to be done. We consider that 2030 is our target year for having co-optimization in the European electricity market. And there's a lot of R&D to be done on algorithm, on products, on interlinking, and all the aspects that have come on the table today. But we do not consider that meaning that something needs to be done so complex like this in 2030 means that we need to stop with it today. I think we need to continue. I think that this is our objective. Also to make sure that R&D continues, that we really look into this and how we can integrate this into the European electricity market. And we hope that over time we can convince also market participants, NEMOs and TSOs that this is the right way forward. I see that we have not convinced you today, but I hope we can continue the discussion and see where we can land this in the far future. Then maybe a final slide. Maybe I don't know who's in control. Yeah, thanks, Jenny. So a final slide. So this webinar is part of a short public consultation we've been doing on the study itself. So we wanted to give you the possibility to provide your input to the study. still open for that until the 19th of June. And of course, this is not the only consultation we've done on the topic. Already earlier this year, we provided a consultation on the actual algorithm methodology, changes that we're still working on. We intend to provide or to publish these decisions by early autumn, after summer. But indeed, this shorter consultation is really on the study, and we really welcome your input to it and your views, and we'll try to respond to them indeed as soon as possible. On the questions, we have a number of them. We'll try to answer them in the Slido itself, so please have a look there if any of your questions weren't answered yet in the consultation. Then I close. 4 minutes late, apologies for that. Thank you for your attention today, and well, hope to see you and talk to you in the future. Thank you.